Club has had many members for a long time. Today we're lighter than usual. One advantage of being lighter in a club that's had so many members is you get an opportunity to give a longer speech. Sometimes we don't speak much when we are in a large club, and I have been frustrated on numerous occasions not being able to take a more complex topic when I'm only limited to a 5 to 7 minute speech. So today, we get to make a choice. We're going to have a longer speech today. Mike Slattery has been a property and casualty insurance agent for Farmers Insurance for the past 20 years. During that time, he has learned his craft through training and education. However, he never took the time to investigate the insurance industry's history. And since this assignment of doing a keynote speech, he decided to learn. Mike will be completing his assignment from the Professional Speaker Advanced Manual entitled The History of Insurance. He will be speaking 15 to 20 minutes. Welcome with me, Mike Slattery.
Thank you, Mr. Toastmaster. There are 4 things that we can never recover in life. 1 is throwing a stone into the ocean. Number 2 is the word after it's been said. Number 3 is an occasion after it's been missed. And number 4 is time when it's passed us by. And that's what I'm going to speak about today. Ancient history time in the insurance industry. When did it start? And how has it affected our lives throughout our lives? As you all know, the insurance industry helps to eliminate risks and helps to spread risks from an individual to a complete community. It provides an important source of long-term finance for both the public and the private sector. Now, in ancient times, when there was no money exchange, no monetary economy, the definitions of insurance were very similar, but not exactly the same because we had no money. You could say that the definition of insurance back then was that of mutual aid. For example, if within a community someone's house was destroyed, the community had an agreement to come together and rebuild that house. A form of insurance. Community involvement. Way back when no money was exchanged. It was barter and trade. Now, the first methods of transferring or distributing risk in a monetary economy was practiced by the Chinese and the Babylonians 3000 to 2000 BC. Now, we all know that means before Christ. But as I spoke to Roxanne this week, today when we read BC, sometimes it says, it says BCE. And that stands for before the Common Era. Or you might see CE, which means the Common Era. Roxanne informed me that that stands for, that came from the Jewish interpretation of the Bible, which means CE, the Common Era, begins with 1 AD. So that was a long, long time ago. In China, some of the merchants would travel many miles over treacherous river rapids and sandy deserts in order to trade their goods. Now, to protect themselves from their goods, from natural resources and pirates or thieves, the Chinese would redistribute their wares on many different vessels, so that in the event of a disaster or a theft, there would only be one ship, and not all of them, and they would not lose their entire wares, their goods. And to me, I would call that was the first time of what we call today being self-insured. The Babylonians, however, developed one of the first, if not the first, written loss limitation methods. It was written on a 7-foot, 4-inch stone tablet. Sound familiar? And it was called the Code of Hammurabi. And it was written in the year 1750 BC. Or you could say BCE, depending on your religious or your preference. This code was the brainchild of the king of Babylon at the time. Half of the code had to do with written contracts, and the other had to do with human behavior, sort of like our modern Ten Commandments. Under this code, a merchant who would have received the loan would pay the lender a little bit extra money in exchange for a guarantee that the loan would be canceled should his wares be stolen or lost. So by paying that extra little bit, that would guarantee that that merchant would not be indebted to the lender or the bank. He would be free as though he had already sold his goods. Now, so far I've been talking about merchants because that's what happened back in BC. But what about us? What about human beings? Well, around 700 BC, the Achaemenian monarchs in the First Persian Empire were presented with annual gifts from different ethnic people that they had conquered. And those gifts were insurance or a guarantee that they would have the Persian king's protection should there ever be needed. So he, or the Persian king, would keep them from harm because he was given gifts from that community. So this would function as an early form of what we call political insurance. Now, I'm not going to make a comment about us giving our taxes and what happens, but in any case, this is basically what happened for the insurance of the safety of another community with the umbrella of the Persian Empire. Now, around 600 BC, the Greeks and Romans formed the first types of life and health insurance, and they were called benevolent societies. These societies provided care for families of deceased citizens. Such societies continued for centuries in many different areas of the world, and they also included funerary rituals or rites. Now, does anyone here have any idea how much our government gives in the event of a death within a family? You get $250. That's what Social Security gives you in the event of a death of a family member. I believe back in those days they were given more, and the reason being is in the event of a death of a family, especially of the breadwinner, the societies would pay so that the family could continue. Now, we have life insurance here now, which goes on, but in any case, that's how it was worked back in those days. Now let's move on. In the 12th century, in Anatolia, Turkey, a type of state or government insurance was introduced. It worked like this. If traders were robbed or lost due to natural disasters, in their area, the Catalonia area, the state treasury would reimburse them for their losses. I want you to think about this. That's really not a bad deal, because if I have a business and I lose money, then I go to our government and say, hey, I've lost money, and they reimburse me. Like I say, not a bad deal. So if you have a loss during doing business back in the 12th century in Turkey, you were doing pretty good. But in the 14th century in Genoa, Italy, standalone insurance policies that were not tied to contracts or loans were issued. This is where the first documented actual insurance policy was written and issued, and it was in the year of 1347. Then in the 15th century, standalone maritime insurance was formed, with the type of insurance premiums varied based on the unique risks and the risk factors that were being taken by the shippers. And at that time, the separation of insurance from contracts and loans was made, and that was a major change. This change would influence insurance for the rest of the time, and that's how most of the insurance policies are written today. And we're going back to the 14th century, 1300s. When the Renaissance period ended in Europe, insurance evolved into a much more sophisticated form of protection with the several varieties of coverages. Until the late 17th century, many areas were still dominated by friendly societies and collected money to pay for medical expenses and funerals. However, at the end of the 17th century, a rapid expansion of London's importance in the world of trade became very evident. The phenomenal increase in trade created a demand for the need of much more cargo insurance. London became a hub of companies and people who were willing to underwrite the ventures of cargo ships and merchant traders. Underwrite means give money to in the event of a loss. An underwriter was at that time. Modern insurance can be traced back to the city's big fire of London, which occurred in 1666, after it destroyed more than 30,000 homes. Then a man by the name of Nicholas Barbon started a building insurance business. He later introduced the city's very first insurance company. This is before Lloyds of London. And that's what brings me to Lloyds of London. The market itself began at Lloyds Coffeehouse sometimes in 1666, sort of like Starbucks today. The coffee house was owned by Edward Lloyd. It was located on Tower Street in the City of London. The coffee house was a popular hangout for sailors, merchants, and ship owners. And the reason being was Edward Lloyd catered to them by always bringing in reliable shipping news. The coffee house soon became recognized as an ideal place to go to obtain marine insurance because shipping underwriters were always there. The shop was always frequented by mariners involved in the slave trade. Lloyd's, like other insurance companies at that time, insured slaves, the individuals, and slave ships, and was constantly interested in legal definitions because they were paying for these people. Legal definitions of natural death and perils at sea. Because Lloyds did so much business with the slave trade, Lloyds became a monopoly on the maritime insurance related to the slave trade, and they maintained it until the late 19th century. Just after Christmas in 1691, the small club of marine insurance underwriters decided to move from the coffee shop house on Tower Street to Lombard Street in London. And at the time, the group put a blue plaque on the site where they moved, and it remains there today. That's 300 years ago. You can go there and you can still see the plaque. This arrangement of underwriters carried on until 1773, when the participating members of another club of Lloyds formed a committee which left Lombard Street and moved to the Royal Exchange in Cornhill, London, and formed the Society of Lloyds, which is what we know today as Lloyds of London's insurance company, although they're just called the Society of Lloyds. In 1838, though, this Royal Exchange was destroyed by fire. And it took 6 years to rebuild until 1844, and during that time, they lost all of their records. And then in 1871, Parliament created what was known as the Lloyds Act, which gave them a sound legal business footing. Around the same time, it was unusual for Lloyd's Syndicate to have more than 5 or 6 backers. Those are the people with the guitas, the bucks. And because of this lack of underwriting capacity, it meant Lloyd's was losing many of the larger risks to rival insurance companies. Then a marine underwriter by the name of Frederick Martin created the first large syndicate, initially with 12 providers, 12 investors. By the 1880s, Martin's syndicate had outgrown many of the other major insurance companies outside of Lloyd's and was one of the largest in the world at that time. Then in 1911, Parliament enacted a second Lloyds Act. It set out that the Society of Lloyds objectives, which included the promotion of its members' interests, and how the collection and dissemination of information was to be collected and stored. One of the most famous earthquakes and fires occurred in San Francisco on April 18th, 1906. We're all aware of the San Francisco fire. Lloyd's losses were substantial, even though they were not supposed to be writing outside of England. They did it anyway, and while some insurance companies at that time here were denying claims, there was an underwriter there by the name of Colbert Heath who famously instructed his San Francisco agents to pay all of the claims regardless of how it happened. The prompt and full payment of all the claims helped to cement Lloyds of London's reputation as a reliable claim payment and important trading partner for U.S. brokers and policyholders. It was estimated that around 90% of the damage to the city was caused by the resultant fires, not the earthquake. Since 1906, a fire insurance policy following an earthquake has generally been specifically insured as a peril under most policies, and that's what happens today. If you purchase your earthquake policy today, it doesn't say anything about fire, but it has to be related to an insurance homeowner's policy that does cover the fire. Today, insurance has become a bit more sophisticated than it was back in the earlier times, specifically back in the ancient times. However, it serves the same purpose, to make us financially whole after a loss. We agree to pay a small, certain amount of money to an insurance company in exchange for a guarantee that that company will bear the burden of a large but uncertain loss in the future. Mr. Toastmaster.